Hey, this is John Smallwood. Today with me, I have a very special guest. It is Barry Dyke. He's the author of currently three books, The Pirates of Manhattan, which was written in 2007, which is a wonderful book that everybody should be getting that really talks about, it was pre the financial crisis. It's a bestseller. He has the Highway to Serfdom. And Barry, what's the third book that you have?
That was Guaranteed Income, which I did with Dave Walker.
Oh, right.
I'm planning for your retirement.
Yes, yes.
Building income streams in retirement. Yeah.
So Barry's been in the industry for about 40 years. I've been in the industry for 30 years, which I can't believe. Started when I was like 2. But the reality of this is Barry and I have known each other for a very long time. We've been in the same circles. We share the same philosophy. And one of the things that Barry is very strong about is creating the protection and the defensive elements of a financial plan. And part of that is revolving around life insurance and annuities to provide guaranteed income and how important that is. And he has a very unique perspective. So welcome, Barry. Thank you.
John, great to see you. Great to see you. And Merry Christmas to you and belated Happy Thanksgiving. So
yes.
Good to see you, John.
Yeah. Good to see you too. Now, let's jump in. Like, what's on your mind now? What are you most concerned about, and what do you see happening in the financial services?
Well, the other day close was like the market closed at high time, like all time high. Yes, the other day. And what you're seeing, unfortunately, what you're seeing is that all the precursors. This is what we saw happen in 1928. The same crap, if you will, before the market imploded. So there's a total disconnect between the real world and the stock market. The stock market is not the economy. It just, and the reason why the economy or the stock market is booming because all the Fed's printing up all this money, and it's all being forced into the market, which is technically in economics called disintermediation. So people are being forced into the market in search of yield, but the problem is that people have less and less and less protection of principal, and which is so. What I've seen in my 35 or long 30 some odd years in the business is that people have less protection today than they ever did, and unfortunately, this is leading to tremendous inequality too. Now, I'm a capitalist like you are, John. I have a business. I have people who work for me. I have equipment. I spend a lot of money in information technology. I'm a capitalist. But right now, what we have is not, capitalism per se. We have crony capitalism, and I'm really passionate about it because you mentioned you have a son like in your 20s, and I have 3 young kids. My father always said you want to leave the world a better place, the way you found it. And right now, Wall Street's just taking over, and so I think this coronavirus thing is really bad. But I think that the bigger problem is the underlying economic problems, the debt. And so this is just some of the things that are drawing my mind right now, but also trying to insulate people from the crap and the gambling and speculation which continues to goes on. Because I've done a number of studies, backed by actuaries, and the whole thing is people do not really make that much money in the market on the long term. They may make it in spurts, and there's always going to be outliers, no question about that. But for the most part, people don't make money in the market.
Right.
I manage money, you manage money. What?
Yeah, there's that Dalbar study that is published every single year that for the last 25 years I've been getting it, and it basically says, the market over the last 20 years has made like 8.5% or whatever the math is, and then as you look at it, the average investor gets like 2.5%, and it's like, and everybody's chasing that rate of return. They're in their rate of return Olympics trying to get to this level, and then it sets people up for failure because they have that missing returnophobia where they're sitting here going, oh my God, I just missed a 20% move, or whatever it is, and then everybody's rushing in to get that repeating return that usually fails them. Like, oh, that asset class was great, now let's go buy it. And you know, my thing right now is you look at the market and you see the PE ratios are like 35 for a lot of these big companies. And historically, they're in the high teens. So you're twice as valuable, which leads to what you're talking about is it's got to either sales have got to increase dramatically or prices need to fall. But I think there's this shift. Like I've been doing this for 30 years, and I know when I first came into the industry, you could get a CD for 7.5%. And if you had $1 million, that was $70,000 a year. It was easy. It was easy to do planning, right? And now, you know, that same $1 million account is sitting in a CD, you're going to get 10,000. So what's happened is people are forced, what you're saying is they're forced to take more risk because of where the interest rates are, and they're forced to put themselves at risk. And it's that volatility adjusted return that just destroys their plan. Like everything's great when it's linear. Like if you could make 4% every single year and take out 4%, okay, you're going to survive. But it's that down 5 and up 0 in the, you know, that just all of a sudden you're on this crash course for running out of capital. And it's funny, every time I get on a podcast or I do something, the leaf blowers show up outside the office building. So if you hear that in the background, we'll try to scrub it out. But they're
tarring the building next door. They're putting a new parking lot here too. So if you hear noise in the background here, but I understand that. But no, and a friend of mine who is I call him a recovering actuary. You know, he told me this. We were speaking a couple of weeks ago. He said, "Well, it's all Tina," and I said, "What's Tina?" And he says, "There is no alternative." So they're forcing people into the market. They're forcing, you know. So you get these giant, I call them communist funds. So you got BlackRock, you got State Street, you got Vanguard, you got Infidelity, you got Invesco, these giant ETFs and the whole thing. They're collecting rents off of people's money, okay? People don't get it, okay, but they're collecting rents, even as if it's 10 bips or 15 bips. And there's no risk to them.
Right.
And now they're getting into private equity and all this other crap. So put people more at risk. And so the whole thing is really protecting people's principal is more important than ever, John. But because the media narrative, you know, you're not going to hear this in the mainstream media. Matter of fact, there was a Matt Taibbi, the author and writer. I was reading a piece by him last night. The majority of Americans do not trust the media, and they shouldn't, because it's really more about supporting advertising. So the people not going to hear generally from the media. They're only going to hear from people like you or me or other folks, Bob Castellone, or but luckily, because I've written these books and things like that, I've been able to get a pretty good audience with other people like Ted Bennett. I don't know if you saw my video with Ted. He's the guy who created the 401k. So a lot of stuff, you know, so a lot of like in planning, it's really about helping people and, you know, really being a good steward, you know, but Wall Street is just one big freaking casino, and it's rigged. Yeah. It is rigged, and it's a big party, okay, and it's a big club, and you and I are not in it. You know? So this is what has happened, and so what we've seen, even since last September, John, when the repo market went into the tank, right. We've just seen unprecedented. When the repo market went to the tank last September or so, now you have these banks now where they're so over leveraged, and there's actually no reserve requirement on banks now, so it's very kind of frightening. But you know, what I'm passionate about is the debt, because if you have too much debt on a balance sheet, a family balance sheet, or an individual's balance sheet, or a business, it never ends up well. And so I think what you and I need to do is just help people have, you know, more secure balance sheets, more certainty, because you know and no one goes to jail on this stuff. I mean, no one goes to jail. I've actually done the research, John. it's over $1/3 trillion in fines. I got a document from J.P. Morgan to Goldman Sachs to all of them. Okay,
In the last,
and
how long? Yeah.
about
Maybe.
past decade. I mean, Goldman just got nailed for like 5.2 billion or 6 billion for the Malaysian bank failure, but no one goes to jail. I mean, it's just it's like paying a traffic ticket. So, anyway, so the point is there is no accountability on Wall Street. The system is rigged, and so it's our job really to tell people the truth and treat them like family.
Right.
And I always tell people, look I'll treat your money like it's my own. And
Right. And it's that balance that you create in the plan. It's that actuarial concept, that actuarial science, that what you're looking at is saying, yes, unfortunately, I love the concept, Tina. There is no alternative, right? So you start to look at it and you say, okay, well, there is money in the stock market. I have to have money in the stock market. And then I start comparing it to cash or bonds, and we're at these super low interest rates, and cash and bonds are not giving me the income that I need. And it's in this moment where we as advisors need to look at the bigger picture and understanding like things like whole life insurance in a client's financial plan. You have the cash value, but you also have the death benefit. And if you treat both of those as assets, you can simulate better returns, because if you understand the power of the death benefit and the power of the stability of the cash value, those are things that I think people don't really understand. And that's kind of one of the things I want to dive in today with you is you have a unique view on the whole life insurance. And as I remember in the Pirates of Manhattan, when I read it, you have a whole concept about tier 1, tier 2, and tier 3 capital of the financial institution. And I kind of want you to just expand on that whole concept. So
okay, well, most of these people, there was a lot of research, whatever, but anyway, so the most important asset in any bank is what is called their tier 1 capital. That's the general account. That's like, think of it like a household account, like your general checking account, whatever. But the most important asset any bank, I don't care, is what they have in their tier 1 capital. Essentially, and the greater the amount of tier 1 capital they have, the more money they can lend out to the public. So as you know, John, reading my books, if someone has, say, something like J.P. Morgan, I don't know, they have, let's say they have 150 billion in tier 1 capital. That means they can lend out at least 10 times that, or over $1 trillion in capital. So it's the most important asset of any bank. Now, as a matter of fact, all the federal regulators, the comptroller of the currency, the FDIC, everybody essentially said you can't put your money in equities because they're too freaking volatile. Okay,
so
they're unsafe.
Equities are not tier 1 capital.
They can't be there. Okay. So the banks probably find a way to get around it somehow. But in any event, so what is considered the safest assets? So they were considered primarily like commercial mortgages. Well, we don't know about them right now, or gold or cash or treasury bills or things of that nature, things which are very, very safe. And the higher the liquidity, the higher the risk rating. In other words, and what I found, and I just stumbled upon this, and this is over a long period of time, is that the banks, in a big way, roughly about 2 decades ago, started buying huge amounts of life insurance for their own account. And the whole thing is that even to this day, okay, the major media will not acknowledge my research. I mean, I've been interviewed by Bloomberg on Lexington Avenue, the whole thing. They still won't reveal this to the public, but it's all a matter of public record. So I discovered that, oh my God, all these banks buy all this life insurance. So why are they doing this? Because they're smart. I mean,
right.
They're smart.
Life insurance. Who are they insuring? What is the concept?
Well, yeah. So what they're doing now, they're insuring the top 35% of their income, their workforce by income. So say something like Wells Fargo, if you will, or J.P. Morgan, whatever. So say most of them employ about 250,000 people. So let's insure the top income third, but say maybe the top 40, 50,000 people. Uh, and they classify it as a way to fund retirement benefits, but that's much of BS because they're actually doing it for economic reasons. But they're putting money into the in cash value life insurance because it's very, very stable. A life company can't lever the crap out of their balance sheet like a bank can. The money grows tax deferred. The money which sits on the balance sheet, okay, can be levered. So for every dollar they have in cash values, they can lever it out to the public 10 times. Now, after last September, now they can lend an unlimited amount of money. They know everyone dies, and people do. And then when people do die, the money comes into the bank income tax free. So they get it. Why does Wells Fargo or Citigroup or all these Bank of America have $22 billion in cash value? Because they're not dummies. And even like E-Trade people, I think Morgan Stanley's by E-Trade, I guess maybe. But so even banks like E-Trade have this for the very, very stable base. So and then they use it also too for executive pension plans and things like that. And we get into that. People can go to barrymdyke.com. But thanks for that. My website up there.
Yeah.
But they can read all about it. So I just discovered this, and so I started doing more research, and then I found that your giant media companies like Comcast, they buy huge premiums for their executives, and people like things that work. And not that life insurance is a panacea; it's not a panacea. I mean, but it works.
And it's that stability. It's that stability that they're looking for, so they can get the leverage that they need, and the power of the death benefit coming in just is amazing. I don't know if this is true or not, but I heard, I read something years ago that England was having a lot of trouble with their pensions, and they started to purchase life insurance on all of their participants, pension-owned type of life insurance, which solved a lot of their problems because as pensioners died, they were getting replenished from the death benefits.
Yeah, but what's a bigger trend, John, which I haven't released to the public, I don't know how I'm going to do this yet, but I've been doing the research, which is even bigger, is that near New York area. I forget whereabouts you, Red Bank, that area? Yeah, so
Red Bank, New Jersey, yeah.
Okay, all right. My brother used to live there years ago, but so what is happening, John, is that pension risk management. The whole thing is people can't, the whole idea that make a long story short. This is what gets my gander, but it's all true, and I've all researched all of this. And you're not going to hear it from the media, but even the media companies themselves, they're turning to life insurance companies to manage their pensions. Fact, about maybe 50 days ago, 60 days ago, New York Times, the old gray lady, okay, who says nothing good about life insurance, nothing good about annuities, they themselves bought another annuity for $235 million. So the New York Times actually bought an annuity for, I think, about total aggregate purchase about $460 million. CBS, that little media company or Viacom in New York, they bought an $800 million annuity. I mean, I go on and on. Boeing, General Motors, Federal Express, all these companies are turning to life insurance companies to finance and to finance and create income streams to people's retirement. So
because of that actuarial,
because the stability. Yeah.
Right. And that in the media, all these great marketing campaigns, that annuity stock and all this stuff that's out there is taking you away from it. But the reality is the companies are actually using these products in a way because of the security that they're looking for. It's a wonderful, it's such it doesn't make sense to me why we would, on one side use it for our own purposes, but on the other side talk negatively about it because It does, because because the insurers really don't advertise much. A little bit of advertising.
They do a horrible job at it. They have probably the best product in the world. They do a horrible job on it. And and I told you I was talking to the CEO of a major company, and he agrees with me. I said, well, why don't you promote it? And you're like, because a lot of these insurers, they have their other, they own broker dealers and all this, so they want to kind of be neutral about all of this stuff. But that's the truth. And but that's what amazes me. And but what I found, John, is not just in the U.S., but it's also in the United Kingdom. It's huge. It's huge. I mean, they're buying billions. Not only that, Bank of America, Merrill Lynch in England bought one for $500 million. They do fund pensions for like 900 people.
Wow.
Lehman Brothers, same thing. Okay? And anyone in the media who's listening to me, I'll give you the details, but you won't hear it in the media. So it's incredible hypocrisy, but that's the trend. And
that's the thing that I'm seeing now also is, like, if you look at some of the largest pensions in the country, both the corporate pensions and the state-run or multi-employer pension systems, they're all underfunded dramatically. And GE is one of the most public ones that you discuss periodically. And 15, 18 years ago, when Jeff Immelt took over GE, the pension fund had an $11 billion surplus and now has somewhere between a $20 and $30 billion deficit. So the actuarial assumptions that they were using, rate of return, didn't provide what they wanted to, where if they had in an insurance company, the insurance company is not using rate of return, they're using mortality science. And that is pretty clear that everybody that's listening to this podcast, you and I, both of us, we're all going to die. The question is what day and time and location. Was it a good ending or was it a bad ending? We don't know. But that's the thing that we need to, like, the smartest people said, oh, we don't need the protection of guarantees and annuities. And now they're way underfunded, and you have 500,000 or 600,000 people that are going to be impacted when they write the pension down. In New Jersey, our teachers' pension fund has 22% funding according to Truth. It's cut 22% funding. So you have like 80,000 teachers living off of their pensions. At some point, if there's not enough money, what do? You got to write down the benefits. And people, I have a lot of clients that are teachers. My wife is a teacher. It's an important part of their financial strategies, but if it changes, it's cataclysmic for them. And I think, it's really interesting that these big companies are moving in the direction of, writing checks to insurance companies to take the balance sheet risk off of their risk. It's really interesting. Now, back to the corporate or bank-owned insurance.
Yeah.
They're doing it tier one capital. It's a large portion of their tier one capital because their lending requirement that they can get whatever the lending capability is, that's considered a very stable asset.
Yeah, so it's like gold. It's stable. It's about as stable as you're going to get. And the whole thing is that, but when you look at the alternatives, what am I going to put my money in an ETF? You know what I mean? Or inverse ETF, which was levered to the moon. I mean, it's just so the debt within, and it's a contract. It's a contract. It says we promise to pay. Yeah. And I'll be the first one to say, there's probably the life insurance industry. I know the industry pretty well. But at the end of the day, they have a heck of a lot more integrity than Wall Street, and which I always thought it amazing that securities are called securities because they're probably about as insecure as you can get. But in any event, so yes, that's and your wife's a teacher. She teaches in New Jersey.
Yep.
You guys are New Jersey, Illinois. Massachusetts, Connecticut, they're like Chernobyls. I mean, it's a very tough situation.
It is. And this is my thing. When clients come in and they're thinking, okay, I've amassed a certain amount of money and I'm approaching this retirement point. And it's how am I going to generate the income? The biggest concern is how do I, go to that? How do I start to generate income from these assets? And so many people are afraid to lose the paycheck because they're sitting here saying, I'm making 1% of my money or less. I have a pension that I want to take, but it is underfunded. I'm concerned about it, but I have this life only option that I have to choose from, that, or joint and survivor. And I've, depending upon the makeup of the family, those pension numbers can be a dramatic reduction. If I'm 70 years old and my wife is 60 and I want to provide her protection of my pension, I'm going to give up 25% of my pension to provide her with, 50% payout or maybe 100% payout. But it's like the people, we're faced with these obstacles that we know are coming. And the key for us is how do you utilize these guarantees in the client plan so they can do larger pensions? They can have this guaranteed income that's a stability as a floor. So if something in their plan goes down because the pension's underfunded or the market goes down, which we know it's going to, how do you survive through a 30, 40-year retirement plan? How do you survive from inflation? How do you survive from taxes? These are all things that are just coming at us. So
Yeah, well, that's what the life insurance is. It's the pension maximization. I mean, it's funny. My neighbor, it's funny. I've spoken around the country, and I've spoken to actually. I was talking to my son about how I've spoken to like full auditoriums in California. But if I do a book signing around here, I'm lucky if I get 2 or 3 people to show up. But the same was true with the Jesus, I guess. But anyway, my neighbor asked me. They said. About buying life insurance because they said they're a union steward or whatever. They said they should really buy life insurance to maximize the pension. So yeah, when you look at the alternatives, and the life company will always be more stable than their actual pension. As a matter of fact, the research, which I think in the book I did, Guaranteed Income, John, I found out was that Wells Fargo has got more money invested in life insurance than they do in their entire pension. So, but no, as a planning tool, you can do so much with it. John, and I don't know how many claims you've had. You've been in the business long. I had my 62nd claim last week.
Did you?
Which, and this is a lot of people, fought me to buy it, but I have a lot of peace of mind. I did it. It was a long-term client of mine, and she was an accountant. Her husband was a chef, and the whole thing. And she'd been disability claim for a long time. She'd been disability for 15 years. I underwrote the disability insurance for her, and then her husband died just out of the blue. And it's just it's really we're able to help people, and bring checks, and we don't have all the answers, but everyone else brings bills, and I've had to settle a number of very large estates with clients. And holy moly, when there's liquidity, when you have that cash liquidity in your bank account, okay, you have a couple $1,000,000 in life insurance proceeds, you can be a pretty good negotiator. If you have nothing, good luck, and so it's really, when you think about it, what we do is really about helping, about loving and caring for families and and their sons and daughters and all that stuff. It's so important what we do, and
it is. It truly is. I think what you're saying right now is, I want to go back to the education side of this for a second, because what we're seeing with the media and not understanding and what we're doing and the training of even the financial services industry is that we're taught that you don't need life insurance in retirement. And that And I see people, you were talking about pension maximization, and I see people, retiring at 55 from, Manhattan, they're police officers or, firemen or whatever it is. And somebody sells them term insurance that's like a 20-year plan to protect their spouse. And the term insurance is like a rental. The premium's super low, and they've convinced them to invest money on the other side. And, if the person dies before the 20 years, the spouse is probably going to be okay if they bought the right amount of insurance. But if, you retire at 55 and you make it to 75 and the insurance goes away and then the market's down and then you die, okay, your family's not going to be the same thing. And I think about it always as, when I sit here and I think about what it is I want for my family and what I want, what my father wanted for his family, you want the best, you want the maximum, and the pressure that a surviving spouse has. We don't know what happened prior to death. Did you end up in the nursing home and have that long, drawn out, destruction of wealth, and then you die and leave your spouse hanging? Did you have that pension that you took the life only option and your wife now has nothing? And then there's the two social securities. You got to choose from one of those. So now you're losing one of those. And a lot of people have, I have lifetime health insurance as part of my overall package for retirement, but it dies with me. They don't understand that, right? And then you end up in a single taxpayer bracket. So like the life insurance, just as we get closer to retirement, we're now closer to death, and the insurance company wants us off the books. Like what we're seeing is that buy term, invest the difference concept that never works. It's just taking all of your money from you. And I think it's, one of the things that we've set up and that we want for our clients is if the client's going to be worth $1 million at retirement, the goal is to have somewhere between $200,000 and $300,000 of that $1 million sitting in a cash value life insurance policy with a death benefit that might be $700,000 or $800,000, and it's paid for. And that provides that stability and that foundation, or the tier one capital, as we want to call it, that when stuff goes wrong, that life insurance policy, because it's a promise, is not going anywhere. And then on top of that, layering some guaranteed income products, and then above that is that risk capital that, go back to Tina for a second, there's no other alternative. How can I get some excess return, either the real estate market or, the investment market? But there's so much, like that's what we're trying to accomplish for the client. But it's the misinformation that's out there is what kills me. It's the half story.
Yeah, it's horrific. So what has happened since 2007, 2008, when I published the first book, and that kind of put me on the map, it's gotten much worse. So there's more leverage in the system. There's more instability. There's less guarantees. So people now more than ever really need to have seatbelts or guardrails around their money. And, because it's just, people don't realize it, John. You're around, remember the dot-com meltdown, 99, 2000, I remember that. 75% of the companies that were listed on the NASDAQ, okay, could make this stuff up. 75% of them went public during 99, 2000. They're no longer in existence. That's according to the Economist. So it's just, and then what we're seeing, I don't know if you've seen this other stuff now with Wall Street, the SPACs.
Yes.
Special purpose acquisition companies.
All right.
It's getting even crazier. Raising money with not even a product. It's like, hey, we promised to raise some money and we'll buy a company. And they're raising records amounts.
It's 50% of this year's IPO market, and they're taking two companies, merging them together, then taking them public, putting together all kinds of different things, marijuana, crazy things. That it's and why did the SPAC come out, right? Why is it out here? There's a whole underlying thing that we could go probably for hours on, but it's a better format for the guys that are taking everybody public. Right?
Well, yeah, because the investment bankers are making a shitload of money. We're bringing the company public, okay, and you got what I call, you have the rise of the communist funds. We have these index funds like BlackRock and yeah, and Fidelity and Vanguard and the whole thing. There's actually no accountability. I get it. I'm kind of a closet indexer myself, okay? But the thing is there is no accountability, okay?
Right.
There's no there's no accountability, and so I think as stewards, like I think we are. I mean, we're in a good business. We have a opportunity to do a lot of good in people's lives. I think we have to take that very, very seriously. Okay, and if you read a arbitration agreement on your brokerage statement, whoever's listening out there, you realize you got nothing to sit on. Okay, or if you read your arbitration agreement or your what was the arbitration agreement? Okay, you have nothing to stand on. So if it's a life insurance or annuity contract, it's a legal contract that says we promise to pay. And and if you read investment, it says investing involves risk. And so we see this wholesale looting of people's money. For instance, you're in New York City, and I was down there last year. My son was he lives up in New Hampshire now, but he was living in Queens before. He's worked for investment advisory. He helps companies raise money, and we had opportunity because I've been following that company WeWork. Do you remember that company, John? WeWork? Sure. $47 billion valuation. $47 billion. I'm like, what? It's just a real estate company. And here's the guy. The guy was the CEO. He's smoking pot and flying over to Israel and buying all these homes, 5 homes around the country and the whole thing. I said, this is crazy. But what makes it even crazier is that the major investors were in WeWork were, I call it Fidelity or Infidelity, Vanguard, T. Rowe Price, Hancock, other people. So people, their mutual fund money is being invested in these crazy startups. And people have no idea because there's a provision within the mutual funds that you can put like 15% of it in non-listed companies. But to me, it's really poor stewardship. So people have this risk.
Yeah, not a lot of disclosure in what you own at any time. So it's very difficult. I mean, we use all the big names because they do good things. I mean, we use index strategies, we use active management strategies in our portfolios, but it's like you don't know what's in there in detail. It's almost impossible to get to it.
Yeah, you can't. And so I like indexing, and I believe in active management to a certain extent. But my point is that none of these guys guarantee anything. And one of the things which John, I have a very big client of mine, and the fact that she was very anti-annuity and anti-insurance. Now I think she's has millions in this stuff now. But now she just isn't. She just as people get older too, you don't have that intellectual capacity, to discern and things like that. And so people just like the peace of mind. When she graduates, and her husband was a good client. He passed away, and then I took over that stuff and eventually took over the account from the Wells Fargo, whatever. But as people get older, I mean, they really all they want to do is they want to enjoy their family. They want to know everything's gonna be okay. They don't want to look at this stuff, okay? And her husband, they were as active as anybody, and they really get it now, and they're just very, very happy. And she says, Barry, I just don't want to lose anything at this point.
Yeah.
The
fear of loss and running out of money is far more important than actually making money. Like people would much rather just, I want to know that it's there and I don't want to lose it. It took me 50 years to accumulate it. I don't want to go backwards.
So that's really, really important. Then you realize, and you have some clients, I imagine you've had a few like that, you realize that the difference in making people's lives. And, it's, and I've probated, I don't know, I've been appointed by 3 or 4 states, and some, it's a can of worms. And the lawyers like it because when it's really complicated, they make a ton. An accounting firm, so with life insurance and things like that, there's no lawyers, no accounting firms. It's just cash right direct to the beneficiary.
Yep. And that, one of the things that's really important when you start to think about big picture planning is the liquidity that the life insurance provides, right? It's a known number. It's going to be here on that date. It's going to deliver it to you. All your other assets, you have no idea what they're going to be worth at the date of death. And, for business owners, I think it's really an interesting thing. So, I have 4 kids, from 24 down to 16, and, everybody's going to be doing different things in their lives. And, you have a business, you have all these things that how do you distribute the wealth when you're gone? And the life insurance allows, for equalization, maybe somebody's going to be in the business, maybe somebody's not. But a lot of times the business is the only asset, and one kid might be working in the business and the other 2 kids are, outside, but all of a sudden the other 2 kids own 2/3 of the business and they're not making any contribution to the business. It's a frightening aspect, right? So the life insurance, the strategies, the tax deferred nature of it, the stability of it, the predictability of it is, at the foundation of a plan. There was a wonderful quote on your website that I saw. I think it's on your Castle your Castle investment with the Henry David Thoreau about, building castles in the clouds. Now is the time to get down under it. I thought that was, I can't find it right now, but it was really, I had to read it like 3 times for me to really grab it. And when I saw it, I was like, it makes so much sense. Like we're building these, in the Cloudlandia, we're building all these castles and there's no foundation under them. And that Tina concept of, there is no alternative, buy risk. If you don't have a solid foundation underneath the plan, when things come down, you don't have any available money to take advantage of it either. And it's that liquidity that you need, in that time frame or for income purposes if you're retired. I mean, that's really where I wanted to today, and this has been a really good conversation. I really wanted to capture, that what the life insurance and the annuity companies are doing is a wonderful, secure, safe way to approach a portion of their retirement plans, something that everybody, all the big institutions are actually using, but it's not in their sales model, so they're not actually discussing it. And that's why I wanted to bring you on today, because when I first got your book back in 07 or 08, when it came out, I was like, wow, like information that I had never actually been, I knew a little bit about it, but I didn't know enough about it. You can get Barry's book, The Pirates of Manhattan, at barrymdike.com. There's the other book that's available there also. It's on Amazon. It's one of the, it's a bestseller. So that's there. As we close up today, Barry, any last words, anything that you want to say?
Yeah, well, listen to guys like John and buckle your seatbelt because this is all the signs are unfortunately the debt levels, the student loan debt, the mortgage debt, the car loan debt, credit card debt, everything's this never been higher, and so we have worked with guys like John to rebalance to fortify your balance sheet, if you will, and this is honest. It's not sexy, so people don't want to talk about it. It's not like, oh, someone talking at a cocktail party, I got, this hot stock, what do I think about Amazon or whatever, it's just some pot stock, whatever. But no, it's not sexy, but it works. And people can go to barrymdike.com. You go to you've seen that I have the YouTube, the podcast, the Economic Warrior YouTube, and
Yep.
So people can. That's a good one. You click on that one down below. Yeah. So luckily, I've been blessed. interviewed a lot of really top people in the industry, and not only that, some celebrities, like guys like Jay Leno, and how they get successful, and a lot of really real experts in the industry, and just to not hear just from me, but hear from others, and all that, and so because the negativity is is it works, and a lot of the stuff just doesn't work and never will work. So I just interviewed Paul Craig Roberts, and I actually interviewed Noam Chomsky, which is probably one of the greatest intellects in the world. So who knows where it is, but
And there's so much amazing content on Barry's website that is out there to listen to consume, and it's this information that I want to get out to my listeners and my people, because the more we can understand about wealth management it's not a miracle product. We both are fans of whole life insurance. We like annuities. We invest in the market. We like real estate. We like all these things. But the industry has a tendency to say, put all your money in this, and this is going to be the miracle product. And the reality is, without the foundations of the solid foundations and the strong balance sheet, all that other risk capital, at some point when it has a problem, you're going to have a problem. Okay. And depending on where you are in your economic timeline, it may be there's no time to recover. So I really appreciate this conversation today, Barry. Go to Barry James Dyke, get a copy of the book, go on the Economic Warrior, subscribe to his YouTube channel, take a listen, and enjoy. And everybody that's on the call today, my book, It's Your Wealth, Keep It, is on Amazon. That's available. So we're trying to get a message out of balance and foundation building. That's really what it is. So Barry, I appreciate you being on today.
Well, thanks for having me on, John. It's great to see you, and hope to catch up soon when this whole COVID is starting to subside. So.
Yes. Okay. Thank you, sir. And I will talk to you soon.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional, and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.